Medtronic is down 4% year to date, trading at its 52-week low. Have we found a company which is trading at the bottom with some very strong upside, offering a forward yield of 3.7%? In today's episode, we're going to understand whether or not Medtronic PLC is trading at an undervalued cheap price where we can expect to see strong growth over the period, as well as some very strong double-digit yield on cost. We're going to jump into their income statements, look at their top line growth revenue, as well as that bottom line net income year on year. We're going to jump into their balance sheet. We're going to take a look at the health check of the company, their total cash versus total debt. We're also going to look at how it has performed its total return in comparison to some competitors that it has over the year to date, as well as the last 5 years. And we're also going to see what institutions are doing with the stock. Are they buying or are they selling? This is all going to lead us into that all-important dividend safety, as well as understanding some very important financial metrics you need to understand before investing into Medtronic. And as always, we will run it through our stock valuation model, getting to the intrinsic value of Medtronic, finding out our acceptable buy price given that all-important investor margin of safety. Now, whilst it has been down 4% year to date, significantly underperforming the S&P 500, which is up around 15%, investors who have been holding the company over the last 10 years, as you can see, remains relatively flat. It was trading at around $75 in 2015. Now, it did hit the peak of around $133 August 2 years ago. And what we want to understand is, at a minimum, can we see those prices in the short term nearly double the current trading price, and therefore locking in a very nice long-term double-digit yield on cost? Now, with the company trading at the 52-week low, let's dive in and see how the company has performed on its income statement. Well, what we typically analyze is the revenue growth year on year, looking for a minimum of 3 to 7%. So April 2019, 5 years ago when they reported, 30.5 billion on that top line, and 5 years later, their latest annual report, 31.2 billion. So what we can see is there hasn't been really much growth over that last 5 years, and when you consider the US inflation rate being 4% on average over the last 40 years, you could argue in real terms there's been no top line growth. Now, on a more granular level, what do we see? Well, we see, in fact, April 2019, the top line decreased to 2020 before increasing again in 2021 and again in 2022 before essentially dropping. So really minimal movement over the top line on a more granular level. Look on the last 5 years. And on the bottom line, net income, well, how does that compare? 2019, 4.6 billion on the bottom line. And 2023, 5 years later, at 3.8 billion. So in actual fact, the bottom line has decreased over the last 5 years. And we can see again the inconsistencies with the increase from 2019 to 2020, then a decrease before an increase, and then a decrease. So fairly inconsistent in terms of the income statement and their top line and bottom line. Now let's look at the health of the company. We do a very quick balance sheet check, their total cash versus total debt. April 2019, 9.8 billion on the balance sheet. Latest quarterly report showing 7.9 billion. So they are holding, in fact, less cash over the last 5 years, but they still have quite a healthy cash balance on the balance sheet. Now, in terms of how that compares to the total debt, in fact, numerically and directionally, what we can see, 25.3 billion on that total debt on the balance sheet in 2019. Latest quarterly report showing around 25 billion. So really minimal movement. It has decreased a little bit, but when we do analyze, it looks like both the cash and the total debt has decreased. Again, no real red flags here so far. Now, very quickly looking at their competitors and how they have performed in a total return performance. So what we can see straight away, their competitors all in the healthcare equipment industry. We have Stryker Corporation, Intuitive Surgical, as well as a few others. Similar market cap as well. So year to date, well, how have they all performed? In actual fact, very interestingly, we can see Medtronic's here, the total return year to date has been the worst performing from their competitors. And again, we can see the best performing BSX up around 13.89%, roughly in line with the S&P 500. Well, I guess what's interesting to do, yes, year to date, the whole industry has performed very poorly. But when we look at the last 5 years to give us a good sense, what can we see here? Well, again, in fact, Medtronic has been the worst performing over the last 5 years, down 11.37%. So not the greatest. And again, if we can see others competitors in their industry up around 60 to 66%. And again, even their worst performing one, at least in the positive. So looking on historical performance for Medtronic isn't really a good indication of the future, but I always like to look at the past performance just to gauge how the company has performed. Now, finally, before we jump into our financial metrics, what we can see here in terms of institutional ownerships, around 81%, which is fairly high. And then when we compare to whether they have been buying or selling over the last 3 years, interestingly, what we can note is on the majority of the quarters, they have been buying more than they have been selling and therefore increasing their institutional ownership. If we're looking just at the last 12 months, we can see the inflows from institutions has been over 13 billion, whereas the selling has been around 8.5. So institutions are buying more than they are selling Medtronics, something just to bear in mind. Now, this leads us very nicely into our dividend safety and our dividend metrics. Well, they have a score of 99, making that all-important dividend very safe, the highest score they could obtain. Market cap, 100 billion. It's therefore a large cap company. And for those who believe we're heading into a recession, well, some recession metrics for you. In the last recession, 07-09, they in fact increased their dividend. Recession sales essentially flat, which was, however, above the average growth rate of companies during the S&P 500 in 07-09, which was negative. And we can see roughly the recession return was negative 56%, pretty much in line with the S&P 500, which was down negative 55. So a little bit there to chew for those who believe a recession is incoming. Now, dividend growth, very poor in my opinion. We had an increase this year of 1.5%. Last 5 years, 8%, which is nice to see. Last 20 years, double digits, very positive to see. But do bear in mind, if your share price is essentially staying flat, as we saw from 2015, the fact that these dividends are increasing whilst it's positive does not take into account that you have been essentially underperforming inflation itself. And speaking of inflation, as I always say, you always want to be looking at increases year on year in your dividends, salary, other income producing assets at a minimum of 4%. As I mentioned earlier, US inflation rate was 4% over the last 40 years on average. One thing to note though, a more positive outlook, they have been paying increasing dividends over the last 45 years. 5 more years, if they continue this, they will gain that all important dividend king status. Now, moving on to dividend yield theory and some positive news. Dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 3.67 versus 2.25. Do bear in mind though, we don't look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. Also note from here that this has been the highest yield on offer for the company over the last 5 years. Another sign of undervaluation, the forward PE at 14.5, sitting below the 5-year average of 18.2. And again, a third and final sign, what we can see here is that Medtronic at 14.5 PE is lower than the healthcare sector PE at 16.3. Now, as I discussed at the beginning of the episode, it is right there at the 52-week low, but bear in mind, I always say this 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now moving on to the earnings versus the free cash flow. Again, regular viewers know this. We ignore the earnings payout due to the fact it is susceptible to manipulation by management through accounting, but it's on there if you want to see the data. Free cash flow, a lot more accurate and a lot more what I would use to essentially analyze stocks. Just to pinpoint one thing that I would say, 2023, if you were to look here, 51%, 2023, 79%. So they do differ depending on which metric you use. Now, for the free cash flow, what I like to see is around 60% and below. The reason for this is I believe it means management are able to effectively offer those double-digit dividends we love to see. 2023, it did go higher than what I like to see at 79%. However, 2024 is expected to come down to 59%. So for me, this is a positive. And as long as it maintains around that 60% level, I will be happy. Although I personally wasn't that happy with that dividend increase, which was very, very poor. Now, in terms of earnings per share, again, data available for investors that like to look at that metric. Free cash flow per share, 455 in 2014, 344 in 2023. Now, I always like to look at 10 years worth of data to fully understand a business. What we can see over the last 10 years, very, very inconsistent. In fact, 2014, they were doing more for free cash flow per share than 2023. And it is essentially downward trending, not something I like to see. But we can see 2024, as is common with the company, it is going up to 466. So a very inconsistent business. Do bear that in mind. Now, total sales, as I mentioned, 3 to 7% is what we like to see. If they're not getting at least 4%, you could argue in real terms they are losing or their revenue is less year on year. Over the large pot, they haven't really been able to hit that on average, as we can see here through the percentages. And below, it's shown 17 billion of sales in 2014, 31 billion in 2023. Now, whilst that may look good over the last 10 years, if you look from 2016, the revenue, the top line, has essentially been fairly flat. So again, bear that in mind. This is not a fast-growing company. Shares outstanding, yes, we love it as investors when companies do share buybacks. 2014 though to 2016, they did the complete opposite, essentially issuing shares, diluting your position as a shareholder. And you've heard me say it before, if they issue shares or they have done it before in the past, they are likely to do it again in times of struggle. So again, bear that in mind. Whilst their shares outstanding from 2016 has remained relatively flat, they did previously allocate or issue shares. Now, ROIC, one of my 7 golden dividend metrics. If you want to see the other 6, check the pin YouTube video. Now, what do I like? Personally, 10% plus. The reason for this, management are able to effectively allocate their capital. And other than 2014, they haven't really been able to hit those 10% that I like to see. Fairly consistent though, it is between 7 to 9% year on year. What I would like moving forwards is to see this percentage go up higher to around that 10%. Operating margin and free cash flow margin, though, one of the very strong metrics for Medtronic. They have been able to consistently get above that 12% and above that 5% on the free cash flow margin. So no issues with that, especially looking at their consistencies. Now, looking at their net debt to earnings for interest, tax, depreciation, amortization, a very important metric. However, it wasn't something I flagged looking at their balance sheet review, as their total debt was essentially flat or remained flat in line with their cash. But what this signals is the maximum we'd like is 3, being the number of years it would take the company to pay off all their debt net of cash on hand. We can see from 2015 it has essentially come down, 2023 at 1.82, 2024 expected 1.79, and that's one of the reasons why we can see this very strong dividend safety 99 very safe score. On the right, purely showing the percentage of a company's financing from debt as opposed to equity. Now, as always, if you are enjoying the content, value is being provided, smash the like button to let me know you are enjoying this content, you want more. Do subscribe and hit the bell button if you haven't already to have these videos delivered to your doorstep. And as always, if you want to grab a copy of the model to run your own companies through to get your own intrinsic value, do click on the pinned comment below. Now, starting off with the first model, we're going to jump straight into it. So it's Graham's valuation. We have the stock ticker MDT, the earnings per share at 271, with the growth rate per analyst estimates at 14, and that yield on AAA corporate bonds, which seems to get higher and higher at 5.41. Now, this gives an intrinsic value of $46, which, as we can see, is significantly under the current trading price, showing signs of overvaluation in the market. One thing to bear in mind with this valuation model, though, is because the current yield on AAA corporate bonds is getting higher and higher, it is decreasing this intrinsic value. So do bear that in mind with this particular model. We then move on to the multiples valuation model, companies that we looked at when we were analysing the total return performance over time. SYK, BDX, SMMNY as one of the few. We then have their stock price, EPS, PE multiples, and then we have the average PE multiplied by the earnings per share to give a stock price for MDT at $107, showing some nice upside to the current trading price and higher than the 52-week range, showing signs of undervaluation in the current market. As I always say, we're never looking at any of these models in isolation and we'll draw conclusions at the end. We then have the yearly dividends for Medtronic. As we can see, they had some very nice growth other than that most recent at 1.47, with the average at 6.7. Now, forward looking, I've gone with 5.5. I do believe they will increase those dividends back to how they were prior. However, those who believe or can justify a higher or lower percentage, if you grab a copy of the model below, you can run your own figures through and get your own DDM price and other prices. So based on my estimates and judgments, the DDM price is coming to $116. Again, significant upside to the current trading price and above the 52-week high that we have seen not too long ago. We then move on to the fourth and final model, the free cash flow, where we have the free cash flows year on year. Average growth rate around 4%, with analysts estimating 9% forward looking. Alongside that discount rate at 8%, we get the essential present value of the future free cash flows and terminal value. Once we add them together with the cash, subtract total debt, we get to our equity value. Divide that by the shares outstanding, we get the DCF price of $91. Now, when we take a look there, that's right at that 52-week high, again showing signs of some significant undervaluation to the current market, currently sitting at $75. Now, essentially, the intrinsic value is the average of the 4 models that we've just run through. And as always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe if you haven't already, and that bell button to join this lovely community. So the intrinsic value for Medtronic is coming to around $90.21. Now, current trading price at $75.13. What I would advise normally, 10% margin of safety. If you're looking for, or you believe the company to have a wide moat, strong financial metrics, good forward-looking data, so your acceptable buy would be up to $81. Now, for those looking for a margin of safety at 15%, your acceptable buy would be around $76, roughly at the current trading price. So if you were to lock in today's price, based on the estimates and judgments run through today, you would be looking at a margin of safety of 15%. Personally, though, for a company like Medtronic, I would be looking for around 20%, and if I was to add this, I would be looking to add around $72. Now, for those looking at 25%, just to make it clear and transparent, your acceptable buy would be around $68. Now, personally, while I don't believe this to be a bad company to invest in, there are some others in the healthcare which I do prefer and that I have run through already on the channel, such as ELV and UNH as some very big ones. Now, in terms of Wall Street and what they forecast over the next 12 months, they believe the price to go higher than the intrinsic value calculated at $94. So they do see some strong upside to the current trading price and believe it'll go over that 52-week high seen a while ago. Now, as always, let me know your thoughts in the comments below. Are you looking to add Medtronic, looking to sell, or even if you're on the sidelines just speculating? As always, if you've enjoyed the content, do like and do subscribe. If you want to grab a copy of the model to run through your own companies, do click on the pinned comment below. As always, have a great day. Catch you on the next episode and take care.